Our next speaker is Samuel Giles. Samuel Giles is a registered U.S. patent agent and has developed comprehensive technology relating to the use of university-owned banks across the American higher education landscape, and is arguably one of the most informed people on how large institutions are managing their banks through the difficult financial environment of today. He will share information he has gathered on the highly regarded public and private institutions of higher education that operate their own banks, why these banks exist, what purposes they serve, what benefits are being derived from them, and how they could revitalize local economies with massive regionalized credit generating power. Samuel Giles.
All right. First, I would like to thank the Public Banking Institute for putting together this fantastic forum for us to discuss and share ideas. Also, I would like to thank everybody at the Public Banking Institute for reaching out to me and sending out an invitation for me to come here and speak to you all today. And last but not least, I want to thank my parents who drove in from Ohio last night to see my presentation. It was my dad and my mom, so thank you all for driving in. And so, and I also appreciate the introduction. Thank you so much. Once again, my name is Samuel Giles, and I'm a registered patent agent, and I practice patent law in the beautiful metropolitan area of Denver, Colorado. And many people will wonder, like, how do you go from patent law to public banking, specifically university public banking? And I have to give credit where credit is due. This is a website called Youku. Youku is like the Chinese version of YouTube. And on Youku, I saw this video, Secret of Oz. By a show of hands, how many of you guys have seen this video, Secret of Oz? Fantastic. It's produced and narrated by Bill Steele. We got to give Bill Steele another round of applause. It was a fantastic presentation. And wonderful work here in this particular documentary. So in this film, I just recently moved to Denver, and all my stuff is still all over my apartment, and I just hooked up my computer, and I'm surfing the net, and I find this link to Youku, which took me to this video, Secret of Oz. And at the end of the video, which took about 4 hours for this 2-hour documentary, because Youku is a Chinese website, and so I had to watch for maybe 4 minutes, and then wait for 4 minutes, and watch for 4 minutes and wait for 4 minutes. But it was very well worth it, because without this video, I would not be standing before you today. So at the end of this video, he showcased some solutions to this public banking problem, and he mentioned these 2 words, university banking. And I sat up and said, hey, wait a minute. I used to work at a university. Wait a minute. I know the university system. I've never heard of a university bank. And so my research began there. So thank you, Bill Steele. So the whole concept of my talk today is how that university banking can actually provide the financing for a great American Renaissance. And so when we say the term Renaissance, we typically think of the European Renaissance, which it was an explosion of art, science, technology, literature that came out across the European landscape. But in preparing for this talk, I realized and I came across how this European Renaissance was actually financed, because we always have to ask ourselves, follow the money. Where'd the money come from? Who financed this great explosion in architecture, literature, and science? So what I discovered was some interesting phenomenon. These were basically an urban phenomenon. So what was the catalyst for the overall European Renaissance? It actually started in Italy. Now, when we zoom into Italy, we'll come into these cities of like Florence, Venice, Milan. These are these municipalities within Italy that actually began to finance a renaissance within these cities. And then what makes it even more interesting is it's not just a European renaissance in terms of science and technology and art, but it's also a revolution in finance with the concept of public debt. And then when you add these things together, we saw an explosion in trade and also in population. Now, these characteristics are also characteristics that are happening at our universities this present day at this time. So in the current landscape across America, of course, we will say that it's probably not necessarily a landscape for a renaissance. Many will think that, but we just have to think about the characteristics of the cities that were the catalyst for the European Renaissance via the Italian Renaissance, and we will see some striking similarities between these universities, which I call mini municipalities, and the municipalities that financed the European Renaissance. So, in my opinion, I follow the lead of Bill Still that if universities can file a state banking charter, that they will be able to provide the necessary credit to fuel and finance explosions in scientific discovery, economic development, and even commission local artisans. Now, in my research, when I was preparing for this particular talk, and also before that, when I was doing some work with the state of Washington, I noticed, and other states as well, I noticed there were about 5 concepts that continued to come up when discussing with state officials on why they could not possibly even move forward with a state banking operation, whether it's coming from a state, particularly with a state agency, creating a state agency. Number 1 was that many states will have something in their constitution that says we can't lend money, the state cannot lend money its own source of revenue. Well, by filing a state banking charter or having the university file a state banking charter, you can eliminate this the constitutional amendment. So you don't have to worry about that. In addition, state treasurers will bring up the fact that they have complex banking relationships, and if the state decides to move forward with a public banking initiative, it will violate their contracts. But by filing a state banking charter through the university, you can avoid that those contracts that the state have with private banking institutions. Also, no state appropriations will be needed. We'll talk about that a little later. In addition to that, many state treasurers have come up with the liquidity risk, saying that if we go forward with a public banking institution, it's going to cause risk of our liquidity management. Well, if you file a state banking with the university, eliminate that as well. And then also, since many of these universities are already quasi-government institutions, you don't need another government agency. So we can very streamlined approach, a very pragmatic approach to be able to get public banking locally. Before I dive into the actual mechanics of the banking charter and how it would apply to public banking, we have to go to the university bank and do some background here. Now, if you can see this, it goes all the way back to the early 1980s with affinity credit cards being used at universities. Now, Georgetown University was the first university to actually create affinity credit cards. And so these affinity credit cards were literally agreements between universities and these private banking organizations. And they would have in these agreements that the university will license information like mailing lists, student information, alumni information, possibly even staff information to these banking operations, and then the banks will then pay a royalty back to the university. And so it's clear to point out, or to be noted right now, that this is a major source of revenue for university alumni associations. Now, this began in the early 1980s with Georgetown, but now there's over 1,000 institutions across the country that have affinity credit card agreements. And it was started between Georgetown and MNBA Corporation, MNBA Bank. And MNBA was actually acquired by Bank of America. So now Bank of America has the largest market share with over 700 universities and colleges that have these affinity credit card agreements. And so in 2009, the Obama administration attempted to curb the marketing efforts that were going on at the universities. And so that was the credit card accountability bill that was passed in 2009. However, that this bill did not drive down into the affinity credit card market per se. So this is still going on right now. From the 1980s, we got to zoom up 20 years until the internet boom bust around 2000. We'll see that universities then tried to mimic the success of affinity credit cards with affinity banking. And so we have Drexel University right here in Philadelphia. They were leading the charge, as well as DePaul University, that they decided to have affinity banks or tried to create affinity banks. And what they were these websites that have university storefronts, if you will. So university insignia and the students, alumni, and all of the customers would interrelate with that university banking website, and all of the banking processing was done behind the scenes, and it was contracted to a chartered bank somewhere in the country. Now, as we all know what happened in 2000, we had the dot-com bubble burst, and so many of these universities decided to get out of the internet business, and so we saw a flight away from online banking, online affinity banking. And so they decided to have a different source of revenue generation for the university and put the burden much more on the students. But anyway, that brings us up into the internal central banks, which is somewhat distinct from the other two methods of generating revenue within the university system. Now, the university central bank is essentially an operation where they bring together three major operations, the asset management, liability management, and also resource management into one function, and then they utilize those three into an asset maximizing function, a bank within the institution. Now, in 2000, let me just say really quickly that previously universities would raise money by going to the bond market, and they would go to the bond market on a project-by-project basis. So if the College of Engineering wanted to raise $25 million, the university would go to the bond market and ask for $25 million. But now the universities actually have a much more long-term vision with their debt. So instead of asking for $25 million, what they do is decide to ask for $250 million or 200 or 300. They get the most amount of money they can at the lowest interest rate, and they hold it. And so now with this long-term vision of debt, if you take all of the institutions around the country that have $1 billion of assets in their endowment, they total over $600 billion in outstanding debt on the bond markets. So this just showcases what level that they are participating in the bond market. They're extremely large players. Some say some of the most aggressive traders in the bond market are universities and colleges. Now, to dive into some of the mechanics on how this university bank works, going back to the example of the College of Engineering that wanted $25 million. Let's say if a university decides to go to the bond market and raise money, they would go out and ask for $200 million and say the bondholder says, pay us 4%. So their external debt rate is 4%. Then the university keeps that $200 million and then decides to lend it internally through their various different departments. And these are pretty major customers. So your College of Engineering, your College of Medicine, they're doing capital projects that are worth hundreds of millions of dollars. So then they lend that to them for maybe say 5%. And then the university keeps that 1% spread as unrestricted revenue. So that 1% net profit margin is unrestricted. And this is a major concept here because the university monies, even though they may have $5 billion in their endowment, they may receive $1 billion from the federal government to do research, those funds have restrictions. And so they can't spend that money any way they want. But when this mechanism comes into place with the university internal bank, they create unrestricted revenue and they can spend it anywhere within the university operation. Now, there are currently at least 13 universities. I was actually on the phone with Moody's yesterday and they informed me that there's more than 13. I don't know, they didn't tell me specifically who else is on this list. But there are 13 universities, at least 13 universities across the country that operate internal banking mechanisms. And if you take a close look at these institutions, they're all located in metropolitan areas. They're all experiencing booms in population or enrollment because of the economic downturn. They operate counter-cyclically. And in addition to that, they are utilizing a quasi-public debt function, just like the European cities that catalyzed the European Renaissance. So furthermore, about this, this internal banking process, is just a way for that central administration can concentrate power and be able to regulate cash flow internally, and also be able to set internal interest rates, that's a function of how much unrestricted revenue they can generate. So it cleans up their process internally. This is another graph here about that internal lending process. You go from the external market and bring those funds internally, start to lend those funds. But the most important here is that the fact that they create a pocket of capital reserves that are unrestricted. And then my argument here is that you can use those unrestricted funds as capital for your bank charter process. You need equity capital, and it could raise anywhere from $5 million to $25 million that you may need to set up a banking operation, where then you can go ahead and utilize the power of fractional reserve lending. So you need the capital. The university generates the capital from internal banking, and then they can utilize that capital for their equity capital to go ahead with their banking charter. Okay, now this is for my academics in the room and possibly on the internet, that the diehard academics, no way, we can't go into commerce. The university has no business in commerce. We're academics. We want to stay outside of commerce, specifically the field of banking. I heard this rejection as well. Well, so I decided to do some research on what type of businesses that the university is involved in. Well, the IRS is the best place to go. So the IRS says, these are some of the business lines that cause concerns for us here at the IRS. It goes from bank store operations, advertising income, and many times they'll set up LLCs as a way to house these business operations. Parking lots, you see here, they charge you when you go to the rec center. They charge the general public, and that's a revenue stream that could raise concerns for unrelated business income taxes. Business incubator activities, our old friends here, the affinity credit cards, a large line of revenue going into the university for the sale and exchange of mailing lists, concession sales, catering activities, athletic events, and those broadcasting rights, very important. Intellectual property, we'll get into that a little later, and even the ownership of S-Corp stock. So these are all the various different business lines that a typical university and college may be into. So why in the world can you not file a state banking charter? So going back to the concept earlier about how when filing a state banking charter, you do not need any constitutional amendment for your state constitution, because it's internal from the university. All you have to do is file an LLC and begin the banking charter process like any other startup bank would do. In addition, you don't need a new government agency, because the university, many times the public institutions are quasi-public institutions, so you don't need to create another entity with another head on top of that agency, another high-powered bureaucrat. You don't need to have another one. You already have one at the university. They're getting paid enough. So once the bank is formulated, what we have here are the typical regulations that make sure that the bank is healthy. And this comes from the FDIC. These are the PCA standards, these prompt corrective action standards. And this is what really the state banking boards are utilizing to showcase, hey, this new bank or any existing bank is okay. So anywhere from well-capitalized all the way down to critically undercapitalized. And we'll see here that we're gonna have to do a little math. Everybody had their coffee already, so we'll do a little bit of math. It's not gonna kill you. Everybody's had their coffee. So to be considered well-capitalized, I took this from a conversation with Joe Vincent from the university, not university, but the state of Washington. He's over in the regulator up there, general counsel. And so in this conversation, he sent over this presentation, and we'll take a look at total risk capital ratio, just one of the variables to be considered a well-capitalized bank. So first, here's the equation. Total risk capital ratio equals the total capital divided by risk-weighted assets. What we want to find out is the risk-weighted assets. And as our discussion has been, the assets are the loans that you get to issue out. So how many loans can you create with the amount of money you want to finance? Now, this is a cash position of the University of Washington in June 2011. From their internal lending program, they had over $50 million in cash unrestricted. So let's just say they take 25 million, we do a little algebra, you know, divide both sides, carry the one, and then now you see that By capitalizing their bank with $25 million, they can lend up to $250 million and still be considered a well-capitalized de novo bank. Let's keep going. So, we don't need any state appropriations. We already have unrestricted revenue. Let's use that to capitalize the banking charter and plow that money into economic development. Oh, another simple equation for you. We take the university internal bank, we add a state banking charter, and we get the foundation for a great American Renaissance. Now, there are several key advantages that by filing a state banking charter will have internal with the university as well as the outside community. So first, it diversifies the banking relationships that the university has. Like I mentioned before, universities operate like mini municipalities. Now, this is a chart of the credit ratings of various different banks, some of the most popular banks that major universities and colleges utilize. And as you can see, there's a major dip right around here. This was the wake-up call for many universities and colleges and their business officers, because we all know what happened here. This economic crisis showcased that universities cannot have concentrated banking relationships. So concentrated meaning having 1, 2, or 3 primary banks that you do business with. When you have a credit crisis like this or a slump in the market, you lose your ability to gain access to liquidity, which is critical for many of these institutions, these massive mini municipalities. So by filing a state banking charter, you have your own internal liquidity generating mechanism within the institution. So it diversifies your relationships and ensures that the institution consistently has access to liquidity no matter what's going on with these guys over here. No added liquidity risk. So the diversification, it eliminates the ability to lose access to credit. So that's another point that we can tell all the opponents within the state governments and possibly even within the universities that do not want to move forward with a state banking charter. So let's keep going. This fuels economic development via technology transfer. So technology transfer, really quickly, is a standard process across many universities and colleges on how universities push out their technologies. So they do a bunch of scientific research, they develop these new technologies, they typically will patent these new technologies, and then they license them out. That's how they get them out to the commercial market. We got to get them out. And so it goes through either they'll license to an existing company or they'll license to a spin-out company. So that if they can't find someone who wants a license and it's a good idea, if the university has the resources, they will create the company and then license the technology to the company. And then the university will get royalties in exchange, possibly even equity stake in the company, and then the outside community will realize wealth creation through the startup companies as well as job creation. So it's very key for economic development purposes, this technology transfer process. Now, even though this technology transfer process is relatively efficient, there is a problem. It's a major problem within this profession, and they call it the valley of death. So this is where good technologies go to die. And they die here because they lack funding. Going back to what Ellen Brown mentioned yesterday. Isn't that something? We have these brilliant minds, brilliant ideas, and they stop here not because of the work ethic, not because of human capital, but because of money, lack of cash flow. So federal and state funding typically are used for only research purposes. You cannot use the state and federal funding for commercialization purposes. So that's a stop right here. Then you have, what about the angel investors? What about venture capitalists? Well, they want to see commercial development because they want a return on their money. So they don't want to invest in something that has not had any type of commercial development. So that stops right around here. So they don't go too far back. And then what about traditional banks, commercial entities? What about them? Well, since this is not even having any type of cash flow, not generating any type of positive cash flow or not realizing any sales, banks will step away from embryonic technologies and new businesses because it's too risky. So who can do this? Who can fill this void? University banks. When you couple a university bank, a university with a state banking charter, you now have the ability to utilize your fractional reserve lending and be able to plow that into university startups and get them over that valley of death. Start building that bridge. In addition, the university bank, with the revenue it generates, can plow it back in. This is basic research funding. So you can start plowing it into the front end and into the back end of that technology creation and commercialization process, fueling your economic development. This is another quick chart here. This may be a little bit difficult to read, but it just showcases how the university central bank can step back and start building that bridge of funding over the valley of death that typically most technologies, embryonic technologies, go to die because they need that assistance of funding so that they can start to commercialize their ideas. So that's how we see the economic development being fueled by filing a state banking charter. Then we also have to provide stable credit for the local community. We'll see how the banking charter can do that. Now, this is a very interesting concept here. In my research, I came across this idea of industrial loan companies and how they're somewhat similar to what a university would be like, or a university coupled with a banking charter. Now, these industrial loan companies, coming from their name, industrial loan companies, their original mission was to provide credit to industrial workers. Now, this may not be a household name, but they've been around longer than the Federal Reserve. And so they've also been able to finance and fuel local development over this entire time. So they've always been able to provide credit locally. Now, these industrial loan companies are now owned by commercial firms that produce products. Now, similar to universities, these firms here, they are not necessarily in the banking business. Neither would a university be. Their main goal is to educate. BMW's main goal is to make BMWs. So industrial loan companies provide the credit for these commercial services for their customers to be able to afford their manufactured product. Similar to a university, a banking operation will provide credit to be able to have students afford their product, tuition credits. Now, what I found was interesting, in 2005, Walmart wanted to get into the banking business. And so there was an outcry from the commercial banking sector and said, no way, we cannot have Walmart into this industrial loan company or basically have a banking charter. So the outcry was so large that Walmart decided to step away and withdraw their banking application. And matter of fact, what came after that was the FDIC slapped a moratorium on industrial loan companies. Now, the interesting thing is that there's a pattern to that. Every time that the traditional commercial banking market is threatened by industrial loan companies, or ILCs, there's a moratorium that comes down from the federal government. Very interesting. And the performance of ILCs have been amazing over time, even to the point where they've already highlighted that this is from John Dugan, the comptroller of the country in 2007. He mentioned that no commercially owned LLC has caused a single dollar of loss in the deposit insurance fund over time. So even though they've been able to perform and outperform traditional commercial banks, they're slapped with a regulation. Now, if you can read this, these are all many of them in the front, you could probably read this, but these are all the countries around the world that do not prohibit commercial firms from owning banking operations. And it's a pretty nice group to be in. There's all the industrialized countries, all the BRIC nations are there. It's a pretty nice party to be in. Now, there are 4 countries on the planet that still prohibit commercial firms from owning banks. So we're going to zoom in. That's Guernsey. That's the giveaway. This is also a geography test. Make sure you had your copy. I'm not sure. Maybe you guys in the front can see this. There's a little red dot here. Anybody in the front, maybe? There you go, Isle of Man. Anybody? Where's Landon? Landon should know this. He can't. Oh, he's in the back. Close. Fiji. Fiji. Now this is a gimme. This is a gimme. So we have 4 countries on the planet that still prohibit the commercial ownership of banking operations. And I say all of that to say that the universities may come into a problem if you start filing state banking charters. We see here a timeline of all the different acts that have been put in place to slap moratoriums on industrial loan companies that have been able to always provide credit locally to people. Starting with the Banking Holding Act of 1956, all the way down to the Dodd-Frank Act in 2010. Industrial loan companies had nothing to do with the economic downturn. They caused no losses for the FDIC, but yet they're the ones with the moratorium, and they have to go to the GAO, the Government Accounting Office, to make sure to get permission for this industrial loan application. Very interesting. That's why I just found that I wanted to share that with you guys. So to further showcase how these things are interrelated is the fact that number one, industrial loan companies have been providing credit even though the economy has been down. In addition, universities operate counter-cyclical as well. So when the economy goes down, enrollment goes up. The economy goes down, enrollment goes up. And so we witness population booms in universities in times of economic downturn. And so similar to these cities in the European Renaissance that had these population booms and operated to plow financing in, we'll see a little connection there between the university and many municipalities. So we've all heard about the student loan debt burdens. Now, we know this is just outrageous at this particular point in time. We know that we've heard from many different sources that student loans have crossed over that barrier of $1 trillion, I believe, this past week. And so how can the universities help students out? We've also have an understanding that these loans are not charged off during bankruptcy. So what can the university do? Oh, I forgot about this. Now, this is very interesting. So in preparing for this presentation, I also came across the Huffington Post posted 2 articles about how students were selling their bodies to pay for tuition. Now, this has just gotten really bad. Don't ask me what the top 10 institutions for sex sale. I'm not going to tell you. We're getting taped right now. But Amanda Fairbanks didn't come out with a list of the top 20 institutions for this type of activity. Now, given the importance of the alumni to the university operation, like I mentioned earlier with affinity credit card banking and how important they are, why in the world would a university want their students to be subject to all of this debt? It impedes their progress as an institution. So let's quickly go through what the role are of alumni on the institution. They operate as ambassadors on their campus to recruit more students, angel investors in those startup businesses that we talked about, mentors for students and for those entrepreneurs on campus, as well as they become the entrepreneurs. This is a great fact here that many universities didn't even tap into this market to find who's going to be the entrepreneur for this new technology develop. Well, you talk to your alumni, so they're very critical. And then they also could participate heavily in fundraising campaigns. So once again, by filing a state banking charter, it's a win-win situation for the university as well as the student. So the university realized an instant revenue stream. So if the University of Toledo, I went to University of Toledo, Ohio, if they called me on the phone today and say, hey, we want to consolidate your loans for, I don't know, 3.5%, good, let's do it. So it's an instant revenue stream by me making my payments. They make money right there, as well as I witness a reduction in my interest rate. So it reduces the student loan debt burden for the student or the alumni, and it frees up the person. So it's a win-win situation for the university and the student. Now, why in the world would a university not want to do this with all these advantages that it benefits the institution, benefits the alumni, the students, and the outside community? What is going on? I don't understand. So I was looking like that for a long time, just holding my head. So why not? Let's start with the Federal Reserve Act, Section 23A, 23B. This regulates how much money a bank can loan to itself. So it restricts the amount of money it can loan to itself and any affiliate. And the term affiliate is a very broad definition. So many university officials will say, no way, we can't get around the Federal Reserve Act 23A, Sections 23A and 23B. Well, what I noticed from the banking operation is that how banks lend to one another. So what would happen if they file state banking charters? Not just one. This is why we're here today, to work as a community to get all of these institutions to file state banking charters and begin to lend to one another. So Duke would lend to Penn, and Missouri would lend to Vermont, and Vanderbilt would lend to Harvard, and so on and so forth. So we would create a national network of universities. We can't file a state banking charter. We have complex banking relationships. We have contracts in place, which is very true. They operate like many municipalities. They may go to one bank for their deposits. Another bank may operate their credit cards. Another bank may be in charge of all of the bond proceeds. Understandable. Well, this may be hard to read here. On the left-hand side is a bunch of banks here in red, and then each column will be various different functions that that bank could operate within the institution. And so the whole point here, why I put this out here, is that once you file a state banking charter, it's not going to be the only bank within the university. It still can maintain all of these banking relationships and fill in the gaps here, fill in a few voids that this bank can operate with. And so it doesn't have to breach on any of the contracts that you currently have in place. So there's no breach of contract there. So we can eliminate that as well. Now, why not? Oh, the Board of Regents and the trustees. Now, many times these people are very knowledgeable and very prominent within the institution that's affiliated with the university bank. And they have a broad array of experiences from various different industries, and also many times that will include banking and finance. So many times you have an old banker, retired banker, or even a current banker on the board of trustees. So it's not a radical thought to say, hey, that banker or former banker would reject the notion of a university filing a state banking charter. So that could be a problem there as well, something they'll have to work around. And then also, why can't this not work what I call inertia? Universities are big, they are massive, and they move like grandma's molasses. Very, very slow. And to make matters worse, they operate many times on consensus. So in order to get any initiative moving forward, they have to make sure we have a meeting so that we have another meeting, and then have another meeting for another meeting. So to move this type of initiative forward would be very problematic within these large bureaucratic institutions. So what can we do as activists and concerned citizens to try to push our local universities forward to get this moving, to have this idea of filing a state banking charter? Well, here's a typical organizational chart of a university, and I recommend engaging and galvanizing the most nimble parties of this university organization, and that will be the faculty senate and the student body government. Now, both of these parties have the ability to submit resolutions to the senior administration. And both of these parties, these resolutions that they submit can impact university policy, and if the outcry is large enough, impact university policy to make the president and CFO move. Now, I would say probably the most important individual on this board is the provost. So the provost overhears all of the activity within the student body and the faculty senate and many of the staff. And what they commonly say in higher ed, that the provost is Dr. No, meaning that the provost hears all of the complaints, all of the concerns, all the squeaky wheels. That's what the provost has to deal with. But because of that, the provost is listening to all of these concerns, and when warranted or when pushed, the provost will make sure that these concerns are heard at the upper levels of the institution, so the battle can go forward. So these three bodies here within the institution is what has to be galvanized and organized and pushed forward. But this can definitely happen. So just a quick recap. There's our equation for the day. University internal banks, couple them with state banking charters, and we lay the foundation for a great American Renaissance that's going to continue the advancement in scientific discovery, get those technologies out of the valley of death with funding by the bank, and also to spur the economic development through that technology transfer process, as well as providing localized credit for companies, and then also relieving student debt burdens. So if I have time, as time is left for discussion and questions, I would like to open up the floor. Thank you guys again.
Okay. Sam, thanks so much. And we'll take 2 questions. I got to keep us on track here today, so questions here. Okay, Susan.
I think that all the universities you mentioned were private. I'm wondering if public So public universities.
But that's a good question though, because I thought about that. Like, why would I want a private university, you know, to have a state banking charter? Would that be kind of like as bad as a J.P. Morgan, or it would not be as efficient, I guess is the best way to put it. And upon further consideration, if you think about it, we have to have an institution that's aligned with your local community, that's committed to your local community. And what better than an institution? I mean, typically, many of those institutions are 100, 125, 150 years old. So they're intimately tied to that community, and they're not going anywhere. They won't be bought out, they won't be sold, and so it's an advantage for the local community. And all the processes still remain the same in terms of like technology transfer, getting the technologies out there. The student body politic will still be active locally. So at least it decentralizes what Bill Still mentioned earlier. It decentralizes that power and brings it down locally.
But would a public university have the autonomy, or would they have to go to the state or whoever?
That's another good question. From my particular research, and I like to get on the phone and actually, this is a contact sport. You get on the phone and you call the university treasurer, you call the university treasury departments, and you look at their bios. These are some powerful people, very intelligent people. They'll leave many times the banking industry and go to higher ed. And so they're working within the treasury departments at these local universities. So the human capital is there. The infrastructure is there. So it's just missing the banking charter.
Hi, I'm Kristen Ragus, and Sam, that was a wonderful presentation.
Thank you. That's a wonderful dress, by the way.
Oh, thank you. Yay. We're in alignment. You know, I'm wondering, with this type of wonderful proposal, would we have the opportunity to get big money out of universities and start liberating education so that we would actually get real education? Many of the economic departments are bought off by ideologies, and do you think that this would provide an opportunity for true education? Question one.
I mean, you said it better than I could. That sounds great. I would hope so. That's a part of the hope. They would free up some of this capital that is basically regulated by the bond market. And so, like going back to that slide on the banking relationships, there's no community banks. I'm not sure if you noticed. There were no community banks. There are typically no community banks that are utilizing the bond market, and those are the transactions between the university and the bond market. So I would hope so. I would hope so. I would think so as well.
I think one of the reasons we're here today is because there is so much misinformation and education about economics. Mm-hmm. My other concern would be, why do tuitions rise the way they rise? And I wonder if it's the same type of asset inflation and speculation targeting students because the lending is available. And so that would be the concern that I would have here. You make the money more readily available, it just fuels you know, education tuition prices rising double the cost of CPI a year, while these endowments sit there and university presidents make an obscene amount of money relative to the students. And so would that question also in tangent be intertwined with this? And then you have an opportunity for real liberation, but without, you know, if we're just going to blow up tuitions further and further, how would we address that issue?
Well, you know, by the university filing a state banking charter and going through those PCA regulations, now the university is accountable for the loans. Currently, in the current structure, the reason why tuition continues to inflate is because the university is just a middleman. Hey, we can't help it. State appropriations got cut. Tuition's got to go up. Like I mentioned, the affinity credit cards, that was a source of revenue. And then the online banks, that was a source of revenue. But the philosophy started to change from utilizing the university internal structure as a way to generate revenue. They started to move that pressure onto students. And that's in my opinion, where we see the rise in tuition. But once there's a state banking charter in place, now the university has a vested stake and interest in the student's success. So they can't afford to have the student walking around selling their bodies to pay off student loan debt, because the university's on the tab for that. It's their loan.
Sam, thank you so much.
Thank you.